Hi everyone, I'm Sabrina. Tonight we're going to walk through one of the most confusing pieces of the loan process, which is the loan estimate. My goal is simple, to slow the noise down, simplify the information, and help you understand what actually matters. So let's go ahead and get started with what the loan estimate actually is. All right, so the loan estimate is a preview. It is not a commitment. It shows your loan structure, it shows your fees, your costs, and it helps compare lenders. So when you're comparing all these numbers, it can get really confusing. So I'm here to break that down. So when you look at page one, all you need to care about is four things: the loan amount, your interest rate, your monthly payment, and your cash to close. Okay. So as you can see, I have faded out a uh, first section of the first page of the loan estimate right here, which does show your loan amount, your interest rate, your principal and interest, if there's prepayment penalty, and if there's a balloon payment. So those are a couple other things you want to pay attention to as well. Um, the principal and interest, be careful because there is a section two that shows principal, interest, and your taxes and insurance as well. So make sure when you're looking at the principal and interest, you know it's just that and that can get a little bit confusing. So you always want to make sure you know what you're looking at and you know what that monthly payment is because some people do escrow, some people don't escrow, which simply means having the taxes and insurance included in your payment. And it's preference. I have clients that like to escrow. I have clients that don't like to escrow. They like to pay it on their own, their taxes and their insurance. So it's truly up to you and what your preference is at the end of the day. However, these are the four essentials when it comes down to it. Everything else just kind of supports those numbers. So now let's look at where people feel overwhelmed, which is page two. All right, page two. This is where the details start. Here is the calm way to think about it. There are three categories: lender-controlled fees, third-party fees, and prepaids and escrows. When comparing lenders, only compare the lender-controlled fees. Taxes and insurance and escrow setup are not a lender decision because ultimately you pay those yourself and those get paid either way. Now, I will tell you that some lenders and brokers do things differently, and also things are different from when you will actually have payments come out because everybody has their homeowners insurance taken out at different points in the year. The taxes as well, each state can vary even, but normally it's just like you have your winter and then you have your summer taxes, is tend to what I see. However, in different areas, those can look a lot different. So just be cautious. And I've even came across situations where clients are either behind on payments or maybe they have like influx of like a really good amount in their account, just depending on their servicer with their lender. So it truly just depends. Kind of want to go over that escrow account, and you should. Usually it's in I think February or March in the beginning of the year, you should have the escrow breakdown sent to you. You're obligated to have that if you do your escrow and your lender does service your loan. You do have that analysis, escrow analysis that will come to you at least once a year. But also, you can always look in your mortgage portal to kind of see where those numbers are and just make sure that you're on pace because nobody likes to get a letter in the mail that says their payment's either going up or they have to catch up on an escrow amount or up to my payment, and they don't realize it. It's just their taxes and their insurance that are going up, and that's what's making the change, or there's a shortage in that escrow amount when it comes down to it. Okay. So let's clear up the biggest confusion, which is points and credits. I'll leave the screen up here as kind of elaborating on um, page 2 here as well. It's got some really good helpful information. I forgot I actually threw this in here. So this kind of goes over the origination, services you can shop for, services you cannot shop for. Actually, that's B. The totals, the other costs, which is again the taxes and government, prepaids that I went over with your taxes and insurance, initial escrow at the closing for so many months, and then closing costs and lender credits there as well if lender or broker is providing any credits. Um, so yeah, feel free to pause this video if you needed more time. Okay. Points and credits. So understanding the trade-off here when it comes down to it. So points mean you pay extra upfront to lower the interest rate, okay? So credits mean the lender pays part of those of the cost. So there's tends to be a higher rate when that happens. It's not good or bad. It just kind of depends on your timeline, your preferences, your monthly payment, where you are super comfortable with. Um, Personally, par rate is great because that actually is the one with like the least cost. However, everybody prices differently. I've priced loans many different ways, and honestly, it just makes sense with what my client has going on at the time. Okay. Um, but yeah. Usually with points, the way it goes is if you do pay points, you're going to get that lower rate, which results in a lower payment. However, with adding more for the points, like so you pay a chunk of money for those points, say like 1,000 or 2,000. Um, that's okay to get that lower payment. However, you want to make sure that you're going to be breaking even with your loan. You're going to be super comfortable with the amount because that could reduce your cash at the end when you go to, if you are in a refinance situation, that can affect that because you would get less cash because the loan is eating a little bit more up with those points. So, just be cautious on that. I always recommend speaking to your lender or your broker, whoever helps you with this decisions, as this is all educational only, just based off of my expertise. However, that tends to be the way they inverse relationships. So if you pay less in points, that costs. Um, and so if you pay like no points or a par rate, the cost is not going to be there. So just so you're aware. All right. All right. Yep. So once you understand that, cash to close becomes pretty simple here. So we'll move into cash to close. All right. So cash to close. Cash to close looks intimidating, but it is actually just a formula. Closing costs. So you have your prepaids, which is your taxes and your insurance, as long as you're escrowing, and then your escrow setup minus any lender credits equals that cash to close. And prepaids, they're not lender fees. Okay. Just make that very clear. So when you are calculating your break even, like I said, you want to kind of set that escrow aside because the taxes and insurance, you're going to pay either way because you're in the home, you're living in the home, you're paying homeowners, just in case something happens to the home and you're paying taxes because obviously we all have to pay property taxes. So, um, yeah. All right. So we'll keep moving on here. All right. So now let's go ahead and look at the last page on that loan estimate, which is page 3 of the loan estimate. And I included a little snippet below too as well, so that way you can get a visual and things that you can use to uh, make a decision when it comes down to it. Page 3 shows the 5-year cost and the long-term interest. This page matters. If you're staying in the home long term, you'll want to make sure that you kind of see the bigger picture and make sure it's going to be worth it to you. So it is for understanding structure of the loan. Annual percentage rate is your cost of the loan expressed as a rate. So that is not interest rate. APR gets really confusing with interest rate. Your interest rate is separate. So your loan will work off the interest rate. The APR is just what you see in the beginning of the process, over the long term. Okay. So it's your cost just expressed in a rate form. But yeah, in the 5 years, you'll see the total you will have. So it gives you a little snippet, a little snapshot with your principal, your interest, your mortgage insurance, if you have that, the loan cost, and the principal that you'll have paid off there. And then the total amount of interest you'll pay over the long term or the loan term as a percentage of your loan amount is the total interest percentage there. All right. So how do you actually compare two loan estimates? So here is the clear order. All right. When comparing lenders, don't start with the monthly payment. Start with this monthly, with this order. All right. So first, look at your interest rate. You're going to want to make sure that the interest rate is going to make sense when it comes down to it. And just overall goals. Everybody has different goals, whether it be lowering the payment, whether it be utilizing equity in the home, many different ways you could do that. And it's good to be knowledgeable and kind of know like what these numbers actually mean. Lender fees is number 2. So of course, you want to compare lender fees to see where you're going to get the best deal when it comes down to it as well. So always looking at what comparing one lender or broker to another can do. All right, so looking at credits, the lender credits, cash to close. Cash to close is very important. So sometimes you'll have cash coming to you as well. Cash that from you. It just depends on what type of refinance, what type of um, loan that you're doing, whether it be a purchase loan, a refinance. There are different kinds of loans out there with the non-traditional models as well that work a little bit differently. So always look at the cash to close. I always say this too, looking at your timeline. So kind of evaluating how long am I going to be in this home? Is this going to really make sense for me when it comes down to it? You want to look at your break even. You want to see if you're going to recoup. Even if you're not going to recoup, maybe this is a temporary move that you have, like you have some personal stuff going on and absolutely need to do this. Or you have family stuff or lifestyle changes. It might be worth it, just depending. And You never know what anybody has going on. I've had clients that are going through lawsuits that are expecting an influx of a settlement. Um, I mean, there are a lot of things out there. Um, Clients have retirement funds, they have 401ks, they have different plans to do this, to do that, money allocated for this and that. And that's the beautiful thing about being knowledgeable. And this is why I love what I do. I love hearing client stories so I can structure something that's going to really work out for them when it comes down to it at the end of the day, and just making sure clients are really knowledgeable about all the options that are out there and what means what. And, so that way you're not making a decision you're going to regret later. And then, of course, comes payment after that. The payments you want to look at because you're going to be making your payments every single month. And I mean, right now, the cost of living is really high. So just making sure that you're really comfortable in a monthly payment that you're not really going to regret. So there's different things and different things you can do out there. So it's always good to explore those options. I love putting together different opportunities for clients and letting them know, like, you can do this, you can do that, um, versus what they're looking at or being stuck in a payment that's higher than their comfort level. But there's clients out there that are really comfortable with a higher payment and really determined to get the mortgage paid off. So that is okay too. Everybody's different. So, my goal is to make sure that clients are very well informed in getting into this decision so they don't regret it at the end of the day. Right. So, yeah. Yep. And then just making sure you're looking at that payment with the taxes and insurance. If you're going to escrow as well is very important. All right. We'll wrap up here. All right. So you want to pause and reflect and look at, really what's my timeline? What problem am I looking to solve? What problem am I solving? Do I need a lower cost, a lower payment, or lower risk? But I appreciate you being here tonight. I hope I was able to teach you something here, and I will see you next Thursday on our next session. Bye.